Welcome to our Monetary Policy Special. I'm Lata Venkatesh. The standout takeaway from the monetary policy announced today was Reserve Bank's bullishness on growth. Over last year's 8.2% growth, the Reserve Bank expects GDP to grow by 7.2% in the current year, up from its previous forecast of 7%, which itself was higher than most people in the market. Besides the increase in the growth forecast, the policy was status quoist. The repo rate, or the signalling rate for banks, has been retained at 6.5%. The stance also was unchanged at withdrawal of accommodation, which is a hawkish stance. In some bond markets, bond dealers and economists are a bit tentative on their guesses of when the first rate cut will come. The market is waiting for the final budget, which will come in July, first week of July, for the deficit picture to emerge, while economists are also waiting for Reserve Bank's definition of what should be the neutral rate, or the normative difference between the repo rate and the inflation rate. Right now, it is 200 basis points, right? That is 6.5% repo minus 4.5% CPI forecast for this year. But does the Reserve Bank want this difference to be 200 basis, 175 basis, 150 basis points? We will know in the next RBI bulletin, according to the Reserve Bank Deputy Governor. To get a grip on how robust the economy is, what are the risks to inflation, what is the impact of the unchanged repo rate on loan demand, I'm joined by an elite group, Mridul Sagar, a former member of the MPC and a Reserve Bank ED, currently Professor of Finance at IIM Kozhikode, Samiran Chakrabarti of Citi, the economist from Citi India, and B. Prasanna, who heads the Treasury at ICICI Bank. In a bit, we will also be joined by the SBI Chairman, Mr. Dinesh Khara. Gentlemen, thank you very much indeed for your time. Well, let me start with the bond gentlemen first, because bonds didn't move at all, although the stock markets scaled new highs, looking perhaps at the Reserve Bank Governor's growth bullishness. Prasanna, to you, what have you made of, what was the key takeaway for the bond markets? Are you all expecting a rate cut anytime now?
So I think, Lata, to be frank, there were not too much of expectations, both on the rate side as well as on the stance change side. And I think both of it didn't come true as expected by the market. So to that extent, I think there's hardly any change in the bond deals. I will just allude to two things which was slightly different and which needs to be taken note of. And one is the fact that there is a dissent of a vote of 4-2 in favor of keeping the stance at the same level and the rate at the same level. So that means there are two people, one more person who has now switched around to the fact that we need to change the stance and the policy as well. And the second thing was the extra effort put in by the governor to tell that he will not necessarily follow the Fed. Now, of course, you can read it to say that it could mean both ways, that he might not cut or he might not hike also, which I think he did clarify that in the Q&A session. But I think these were the two important takeaways for me, that he took some pains to establish to the market that he will not necessarily follow the Fed. Having said all of this, do I expect a rate cut anytime soon? I don't think we have changed our estimate. We were earlier in the October to December quarter. Even now, I would say that we are possibly in the October to December quarter where the rate change comes. But I mean, it's quite possible to now say that the stance change can possibly come a policy earlier, which is the August policy, especially if inflation is behaving itself and they are able to draw a trajectory of inflation coming down to the 4% kind of a range. And like you said, bear in mind that if the neutral rate was earlier at 1%, even if it is increased to real rates, even if it is increased to 150%, 150 basis points, you're talking about a possibility of a rate cut really emerging. But that is for the later part of the year.
Okay, October or December, can you give us a little more clarity?
No, it's difficult, Lata. I would say possibly it could be either in October or December. In any case, we don't expect more than 50 basis points. So one of the two rate cuts will happen in one of those policies, okay, and the next one will probably have the next.
Okay. All right. Samiran, should we give so much weightage for the two dissenting voices? Since, as you point out in your report, this entire set of external members are going to change from October.
That's true. I mean, it's quite clear that finally the RBI's internal members' views will dominate at least the MPC action, and these external members will be replaced by somebody else come October. And the way the law is framed, there is no chance of even their terms being extended or anything like that. So, for all practical purposes, from October onwards, we will have a very different faces on the MPC with maybe different views. So,
What is your
while
reading of, dovishness or whatever, next rate cut? What was your takeaway?
So, I mean, the way the RBI is framing the whole issue, growth is not a concern. So, there is no reason to cut rates on the back of growth. Now, world over, central banks are considering rate cuts because they are concerned that real rates in their respective countries are too high. And that's where this announcement or the publication of what RBI feels the optimal real neutral rates are, that becomes important. That then RBI probably will guide us on whether they also feel that the current real rates that's there of 200 basis point is too high or too low. The caveat that I will put is that this whole discussion around real neutral rate versus actually observed real rates, they also will depend upon where we are on the cycle. If we are off from our inflation target, then it is quite possible that the actual real rate will be higher than the real neutral rate that comes out of the RBI's exercise.
Okay.
So there comes this RBI's current view that they're extremely determined to get inflation down, aligned with 4% on a durable basis, which could mean that they can keep possibly the actual real rates slightly higher than the real neutral rates also.
Okay. Actually, Mridul Sagar, I brought you last because I think you are best placed to explain how the RBI thinks about it. I think during the Rajan Urjit Patel years, the real rate was kept very high simply because we were forcing the country towards the 4% inflation. What is the thinking? Latest recent figure was that the difference need be only 100 basis points or even less. Can you read the RBI's mind for us? What are we likely to get?
So, Lata, I have some difficulty in saying what RBI might exactly be communicating because I am not privy to what's happening now.
No, just your guess.
I would rather wait for the June bulletin to come out before giving a prognosis on this. But I think clearly the real rates are higher than any estimate of the neutral which will come. So it is inconsistent with the stance of withdrawal of accommodation, but that needs to be probably clarified by the RBI in better terms because it's true that maybe in the current milieu it's hard to say that the monetary policy had moved to the tightening stance. So to my mind, there's nothing wrong in communicating
as Samiran says, probably, you're still far from the target of inflation, right? So, therefore, you have to keep it a little above your assumed neutral rate.
So, actually, the neutral rate concepts are also so vague in literature. So there are two minds. One is the long run natural rate.
Okay.
So I think that's what we are talking about here. And I would wait to see how RBI defines its neutral rate because you have the short term R star and the long term R star also in the calculations which the Fed does.
Okay.
So while implementing that, we have to see the fine details of what methodology they have adopted, what communication they have done. And if it is the long run R star, which is typically what is the matter of interest, then the point is, one option is that it's okay to say that monetary policy has tightened above the neutral rate, which was required to bring down the inflation to the target.
Okay.
I mean, there's nothing wrong in saying that.
Okay.
Now, the point is that the whole estimates of the neutral rate are pretty dependent on long run variables
Okay.
when we come to the long run neutral rate.
Fair.
So it actually depends on savings, on productivity growth. So whether you are seeing a boom in the potential output,
Yeah.
all this will have to be explained when you actually communicate what it is.
Okay.
But
So the
is
long
it
and the
that
short of
RBI
it
wants
is.
to have more rule-based policy than discretionary policy? That's another thing we will need to watch out after the estimate comes.
Okay. Well, I think, we have taken the discussion a bit too academic, more on the lines of what a person like Samiran will watch out for. The large mass of people want to know more about growth and the next rate cut. So, Mridul, do you believe that the RBI is overestimating growth? They have been damn right. They were ahead of the market in FY24 also, higher in their optimistic in their estimates, and it turned out growth was even more strong than their own estimates. Do you think they're overestimating growth at this point in time? And also, what do you think is the potential of the economy? Do you think we go on like this?
Okay, so whether they were bang or not, I don't really know for sure, because they were at 6.5 till almost I think October of last year, and then these numbers moved to 7, and then the realized numbers were higher, and sort of for the last year and this year, clearly what they are targeting, they've raised from 7 to 7.2. I think that's reasonable if the GDP data, the way it is coming, it's ought to be raised, factoring in that.
Okay.
Now, how reliable that GDP numbers are, we have to factor that into the terms of uncertainty about the monetary policy. Monetary policy under uncertainty will need to factor in not only uncertainty about geostrategic things, about oil prices, but also about how reliable the GDP forecasts are. And GVA numbers are slightly lower.
Yeah.
We know that the discrepancy is large. We know that the service sector deflators are not accurate. So to little bit, you need to adjust for that.
Okay. Okay. Samiran, your sense, do you think the potential of the economy is really 7? Because that repeatedly came out even in the governor saying that over the last 3 years, over the last 4 years, the average is high. Are we quite clearly a 7% economy, or are we just filling up COVID gap?
So most likely the potential growth that RBI will be factoring in for the neutral rate calculation, etc., should be 7 or above. I can't think that RBI will work with a number which will be lower than 7%. And again, the problem for economists is that there are two different approaches of getting into this potential growth. One is just to look at the past growth, which you were referring to, that if last 4 years growth is about 7%, or then our trend growth must be 7 or above. The other way to is look at what factors of production we have, and in a productive way, how much growth can we generate out of it. So generally, we don't do it with the second approach. But if we do it that way, maybe we come out with an even higher number on potential growth. So to me, 7% number on potential growth should not be too far off the mark.
Okay. Yes, we are also on the verge of our demographic dividend. China at that time generated double digits. So perhaps a higher potential growth from the Reserve Bank should not be ruled out. Okay, coming back to brass tacks in terms of cost of capital. Prasanna, the yield didn't move at all, 7.02. What do you think, for the quarter and for the year? How do you see the cost of capital, or at least the 10-year bond yield moving? I'll come to the rupee in just a minute.
Yeah, so I think, Lata, the 10-year yield is possibly going to be within a range of around 6.9 to 7.05 over the next couple of months, till we get to hear from RBI in the next policy. But of course, meanwhile, when the June bulletin is out, it will be interesting to see what kind of real rates and all that they are going to be putting it out. Because then if you can put an estimate of 4% inflation at some point of time. They will have that projection for 1 year down the line. And then if they give, whether they are giving 100, 150 or 200 is something that will kind of then determine what will be the extent of rate cut in the cycle. And then the market will start kind of factoring in where the bond yields should be going. But at this point of time, 690 to 705 till the time we get fresh information. And I would say that whenever if my theory is right, that they change their stance in the August policy, but the rate cut itself is a little back-ended, whether it's in December or maybe even in the first quarter of next year, that will still not prevent the bond yields from going towards 675 and even slightly lower because of the expectations that, at some point of time, the rates are going to be cut. But all of this, of course, assumes that the inflation trajectory moves as per expectations as it is right now, also assumes normal monsoons and those kind of stuff. And the current dispensation in the global market is that you're getting softer data and you're getting Fed is possibly going to cut once or maybe twice max this year. And you've seen other developed countries like Bank of Canada and ECB also cutting rates. So there is an environment which has turned bond positive as far as developed markets are concerned. So given all this, my assumption would be what I had earlier spoken to.
Okay, but Samiran, any chance that the fisc can be deeply disturbed when the NDA met? Nitish Kumar actually turned to the Prime Minister and said that I have been asking for a Bihar package, now you will have to give it.
Well, at least for this year, we don't have that big a fiscal risk because even if the government wants to stick to that 5.1% of GDP fiscal deficit target in the interim budget, there is ample room that has come out of the large RBI dividend and better fiscal performance in FY24.
Yeah.
So the runway looks much cleaner. But at this point of time, bond market was starting to expect maybe a lower borrowing number. To that extent, that has got calibrated back into the borrowing numbers not being unchanged now. But from a monetary policy perspective, yes, RBI will be watching this closely, but it's likely a lesser chance of surprise coming out of that.
Okay. Very quickly, you have a view, Mridul, on the currency? I mean, we were expecting a great deal of flows because of bonds and equity due to the stable government. Do you see a chance for appreciation now?
There would still be some bond flows which would come in because of the index inclusion, and we also have to wait and see if there are more index inclusions coming. So there is no doubt about that, but we'll have to wait and watch the economic program which the new government in place, a coalition government, comes out with before forming a view on the rupee.
Actually, out of time entirely. Can you all just give me a rupee range, Prasanna?
I would say 82.5 to 83 or 84 over the next 3 to 4 months.
Okay, so not serious appreciation. Samiran?
Today, all my views are exactly same with Prasanna's views.
Okay.
We haven't done any previous consultation, but that's how it is.
Oh, good. Okay. Thank you very much, Mridul, Prasanna and Samiran, for giving us more color on the state of the economy. We have to take a quick break, but don't go anywhere. We should be joined by the SBI chairman in a jiffy after this break. Welcome back to our Monetary Policy Special. We are now joined by the biggest banker in the country, Mr. Dinesh Khara, chairman at SBI. Mr. Khara, thank you very much. And thank you actually for unfailingly joining us in a Monetary Policy Special despite a very packed schedule, I'm told. Well, you know, the pointed thing I wanted to ask you is that they have upped the definition of wholesale deposits. Does that, I mean, it becomes 3 crore now, not 2 crore. Does it mean more expensive deposits? Do you think many banks could be hit?
First of all, thank you very much, Lata, for having me on your channel. When it comes to the revision in the bulk deposit definition, I think the intention is that when various banks are raising these bulk deposits, they should be mindful of the cost at which they are raising these deposits. So that is what the intention is. But I really don't know how many of the banks will really get affected, because each of the bank would have different threshold for the bulk deposit. and they are offering differential interest rate for the bulk deposit depending upon their ALM situations. So that's the intention, it seems, and nothing beyond that.
Only those people with a lot of large amount of bulk deposits will be squeezed. Otherwise, this is not really affecting the system, right?
Yeah, that is, and also it's not much of a difference. It is actually 2 crore to 3 crore.
Okay.
So I think I don't really see much much in this.
Okay, then I won't waste time over it. The more important thing is the Reserve Bank is quite gung-ho on growth. They have upped the forecast. You are at a better position to judge the demand for credit. Do you think the economy is that robust? Because we saw credit growth actually falter a bit. If you adjust for the HDFC merger, it's actually the growth has fallen from about 16% plus that it was earlier in the year to about 15 point something. Is growth?
I think this kind of aberrations are quite normal. You know, these are the difference. The credit pickup at times depends upon the actual economic activity on the ground. So we also observe that, when it comes to the GDP growth, we have invariably seen that, we normally get to see higher GDP growth in the later quarters.
Okay.
And as compared to the earlier quarters in the financial year. So I think this marginal difference here and there in terms of the GDP growth will also impact the credit growth. And as you mentioned that it's about 0.5% difference what you are mentioning in terms of the in terms of the credit growth.
Yeah.
So I would rather say that the growth projections which have been indicated by RBI, they are actually based upon what they have seen in the previous year and how it is really evolving in the current year. So that is something which seems to be the guiding factor for revising the growth projections.
You speak to a wide range of borrowers, private sector borrowers, infrastructure guys, public sector guys as well. Are you getting a sense that the capex cycle is well and truly up? Is there those animal spirits there to believe that we are in a good capex cycle?
No, I would say that yes, because considering the pipeline which we have for the mid-corporate and large corporate projects, so that is a very clear reflection that we don't see the demand tapering off. So it's quite, I would say that it is actually quite encouraging to see this kind of a pipeline.
Okay. And what about the RBI not changing its cost of credit, repo rate retained at 6.5? You see that as an impediment? The best guess, according to economists, is that they may cut perhaps in the last quarter of the calendar. That's, the third quarter.
Yeah, even our expectation is also somewhere around the same time. We are expecting the interest rate reduction around the same time because as we have observed from the past, in the past also, RBI is very clearly and very closely looking at various data points and they are looking at the inflation trajectory. And we are quite hopeful that this monsoon season perhaps will get to see better performance of monsoon in the country and which will also lead to the inflation getting recalibrated to the levels which RBI would be comfortable. So all these factors, to my mind, will lead to some kind of a interest rate readjustment. And also the way the governor has indicated today, the way and also the kind of trends which you're observing across various central banks.
Okay.
Perhaps in the past also we have seen that the RBI has decoupled itself and they have addressed the economy's concern only. And I think based upon that, if the inflation comes within the range which they are hoping to see it, most likely in the third quarter we are also hoping that there should be some kind of interest rate cut.
Okay.
And its overall impact on the sentiments of borrowers to really go ahead with their projects, I don't really see much of a impact of this kind of interest rate would not have so much of impact for a promoter to pursue their
point.
Project.
Yeah, if there is an animal spirit, then the cost of money, whether it's 6.5 or 6, shouldn't make a difference.
Yeah.
Point taken, sir. Finally, the political setup will determine the animal spirits as well. Would you worry that it's not exactly as it was in the last 5 years? Will that put some brakes to the capex cycle, some hesitation for new investments?
As far as I'm concerned, I don't see any kind of a hesitation in the mind of the investors. So I think the complexion will be more or less the same.
Okay. All right. On that optimistic note, Mr. Khanna, thank you very much indeed for joining us. Key takeaways from our economists and the top banker is that growth looks fairly robust. The Reserve Bank has put its seal of approval on that. Well, we'll have to wait, of course, a bit on whether they will have the courage to reduce the interest rates. Looks like we have to wait for the end of the year for that. All eyes now will shift, of course, to Delhi and to the budget. Thank you very much for joining this Monetary Policy Special.